Very good afternoon. I hope that you can hear me okay and see my screen all right. If you could just let me know that I'm coming through loud and clear, that would be helpful. And if you could just let me know you can see my main screen. I've had some screen and audio problems today, so if you could confirm that they're coming through okay, I would appreciate that. Thank you, Josh. That's very helpful. Had a bit of a problem with an earlier webinar, so that seems to have all resolved itself. Wow. I'm really looking forward to today's session because I'm going to be able to give us some clarity on where we're at with some pretty uncertain markets. So just to make clear, as we go through different entries, exits, the whole idea of this webinar is it's an educational webinar. You look over someone's shoulder, my shoulder, with a professional trading background, you see how I go about making trading decisions. The idea is that is helping you inform your decisions. And over time, those who've attended this webinars for sort of, weeks and months and years, their understanding of financial markets rapidly improves. So that's the whole idea about these webinars and why HYCM offers them as a broker. Don't forget, the issues we'll be looking at today is looking at the CAD, Aussie, US dollar, little bit of gold, looking at the US dollar and the yen. And I'm going to take us through some very key markets to really help us understand what's going on. So I hope at the end of this webinar, you're going to really see the importance of a couple of events, and that's going to put the narrative on the overarching market themes. So without further ado, I want to jump over to my other screen. And what I want to show you here is there's two fears that are driving the market. Fear number one is the uncertainty over the Omicron variant. Now we can see that with the volatility higher. We can see volatility in bonds high. We can see volatility for oil in the OVEX high, volatility in the VIX high. So you can see VIX, the bond volatility, oil volatility, and the VIX/VIX ratio, all showing highly elevated and volatile markets. When markets are like this, it's due to intense uncertainty. The intense uncertainty is surrounding how serious the Omicron variant is. At this stage, yes, we've had opinion, we've had anecdotal evidence that it's going to be more transmissible. That seems to be reasonably accepted, particularly with that surge higher in South Africa cases. So if I just give you a quick look at that, if you look at the South African caseload, I'll show you here. You can see the surge higher in cases really quite pronounced. It really does seem to be more transmissible compared to earlier spikes in South Africa, but the hospitalizations are relatively still low. So at the moment, the question is, yes, it's more transmissible, but is it more deadly? The best scenario would be, yes, it's more transmissible, but it's less deadly. So more people end up getting a milder version of the virus. And so it ends up being actually a positive development and the end of COVID-19. But I'm not a trained immunologist or a virologist, and we haven't had official word from those who are in the virology or the immunology industry to confirm exactly what's going on with this Omicron variant. So as a consequence, we have intense uncertainty surrounding the Omicron variant, and that is what's driving volatility higher. So you understand that, you understand what's driving it. Now there's another cause of concern that may be less obvious to you. And and this is the volatility you can see in currencies, Aussie, CAD, major currencies seeing a volatility spike higher. Okay, so that's the volatility. But there's another concern that you may have missed. Now, this concern here, and this is illustrated by this euro dollar futures chart. Basically, what we can see here with the euro dollar futures chart is we can see that if you look at the 2023 Fed Fund futures expectations and you take them from the 2024 Fed Fund futures expectations, what this chart is telling us, and it's very marked, that the euro dollar futures are expecting no interest rate hikes for 2024 at all. So that sharp move lower thinks that the market thinks that there's going to be no interest rate hikes in 2024. Now, what that means, and you can see this illustrated with the bond market generally, if you just take a look at, let's just take a look at the 2 years, the 10 years. Do you see how, do you see here the 2-year bond yields are moving higher? That's because the Fed's expected to hike interest rates because Jerome Powell signaled a faster taper. But you notice how the 10-year, the dark blue, is pushing lower. So, you know, if the market was sort of positive about this Fed interest rate hike, it would be, you'd see the 10-year moving up as well. But what it is, you can see that the 2 years moving higher because interest rates are expected to rise. So, you know, no one wants to hold a bond in the near term. But the 10 years are dropping lower because investors are thinking, well, the flattening of the yield curve is investors saying that the Fed's probably hiking too soon, that they're going to slow growth down. And in the long run, that growth is only going to end up being slowed because the Fed has moved interest rates too quickly, and that's what the 10-year, 2-year spread tells us. So that sharp move lower is just, you know, amplifying that fact. Now that has market analysts looking back to 2018 and saying we might be about to see the Fed make a very similar mistake to what they made in 2018. Now, if you look with me here, the yellow line is the Fed's interest rate of 2018. And if you notice, going into 2018, we saw the 2 years moving higher, the 10-year moving higher. We also saw S&P 500 moving to the upside. We saw oil sort of drifting lower. Now, what the Fed did at the end of 2018 is they were pricing in 4 interest rate hikes for 2019. But you see how the 10-year, the 2-year collapsed, and you see how the S&P 500, the orange line, fell 20% at the end of 2018. That was because investors thought that the Fed was moving interest rates too fast, too quickly. So we saw a sharp move higher in stocks, sharp move lower in stocks. So just watch out, because if the Fed are seen to be moving too quickly again, and they will have their interest rate meeting next week, then we could see another sharp correction in US stocks. So be careful out there because there is heightened risk. And notice the difference between now and 2018. One, obviously the Omicron variant. Secondly, the major difference is look where interest rates are now with the Fed, very low, whereas they were relatively high compared to 2021. So we just have to be aware that we're in a similar potential situation, but also slightly different. So if the Fed are perceived to be raising interest rates too quickly, and at the moment, euro-dollar futures are pricing in around 3 interest rate hikes next year, the last time I looked. So you see in 2018, they were pricing in 4, and the market tanked lower. And we're seeing 10-year yields moving sharply lower at the moment, okay? And you know, that is a concern going forward. So we just need to be aware of that dynamic. It wouldn't be a massive surprise to see a significant sharp move low in the S&P 500 if the Fed are perceived to move too quickly. So you now have the twin narratives that are really driving markets. Omicron fears on one hand, and concerns that the Fed is maybe moving too fast, too quickly. Now, how does that impact across other major markets? So the key dynamic to be looking for, let's just see, yeah, I'm gonna go back to the main screen, is this. Now I'm gonna show you a couple of key opportunities to be looking for. There's great risks in this kind of market environment. There's also potential opportunities. So this is the thing to look for. And these are the currency pairs you're gonna be looking at, okay? So I'll just make this nice and sharp. If we have data suggesting Omicron is much less lethal than Delta, and if we have pushback from the Fed In other words, that when they meet next week, they are not going to go on a more hawkish path. At the moment, the expectation is they're going to speed up their tapering. If they slow down their tapering, or say we're going to stick with the current level, and if the Omicron is seen to be less lethal, then we'd expect to see a sharp move lower in the euro and New Zealand dollar pair. Now, let me just show you this pair and why the opportunity is potentially there. Now, if you look at this pair, the sharp move higher in the euro and New Zealand dollar has purely been on the risk-off trading. Why? The euro is a funding currency, and what a funding currency means is it's a currency that has a low interest rate. So often investors will pair it up with a currency that has a high interest rates. That's what a funding currency is. So the Japanese yen is your typical funding currency. It's got very low interest rates, and so typically traders will buy when they're feeling positive at rest the Aussie yen, New Zealand dollar yen, and they use the yen as a funding currency. So by holding that FX pair, you gain a little bit of money each and every week that you hold that risk pair. And so you pocket the rollover each day. So you want to have a low yielding funding currency to trade your high betas against. The yen is a funding currency. The Swiss franc is a funding currency. And if you notice with the ECB, you'll see that the European Central Bank has very low interest rates as well. So you see Bank of Japan interest rates negative, and you can see that the Swiss National Bank interest rates negative, and the ECB also has very low interest rates as well. So that makes it very attractive as a funding currency. So when markets turn risk off, you are no longer wanting to sell funding currencies, and you see moves into the yen, into the Swiss franc, into the euro. Let's just see if I can show you this. Not sure if I've got a yeah, I'll show you here. So if we go back to we go back to November. We saw November the 29th was when we saw the sharp risk-off trading, right? Now that was as the Omicron variant broke. So if you go back to November the 29th, let's just go back. Yeah, okay, so it's just around there, 29th, there we go. Do you see how you've got the Swiss franc, the euro, and the yen are the strongest, right? So that euro strength has been because the euro is a funding currency, as you understand now. Now, the New Zealand dollar has been weak because it's a high beta currency. And if you go and look back at this currency strength, you can see, look, since the Omicron variant broke, we've seen weakness in the Aussie and the New Zealand dollar. So if we suddenly saw the Omicron variant, risk being downplayed, then we'd expect this to move sharply lower. Now, this is the bond yield spread between German 10-year bonds and New Zealand 10-year bonds. And what a bond yield spread is essentially a risk profile. So it just lets you know what bond traders are expecting about the outlook for interest rates for the following currency. And you see how the currency pair tracks the bond yield spread? So dropping bond yield spread, dropping currency, rising bond yield spread, rising currency. You get the idea. So notice we've had a falling bond yield spread, but the currency has risen at a much greater pace. So that means there's something wrong, out of balance here. Now, either the bond yield spread is going to surge up and connect price, or the euro New Zealand dollar pair is going to drop lower and move down to the bond yield. That's what we're looking for. So if we see concerns about Omicron fading, so either much less lethal, or say Pfizer or Moderna or AstraZeneca come out and say our vaccines are 80% effective against Omicron variant, then we'll see euro New Zealand dollar move lower sharply. Okay. Also, if we see a surprise missing core headlines for CPI this week, that could also give some downside to the euro New Zealand dollar because of the Federal Reserve risk that I've already outlined. Okay, I hope you understand that. Now, the other currency pair to look at the dollar CAD. Now, the reason the dollar CAD is good to look at is because, let me show you. Let me show you. You'll get something here. Now, if you notice the dollar CAD, if I overlay oil chart onto dollar CAD, you'll notice something, right? Now this is the oil chart inverted. I'm gonna uninvert the chart for a minute. Okay, so you can see, look, when oil rises, dollar CAD falls. When oil falls, dollar CAD rises. When oil rises, the green, okay, you see that dollar CAD falls. Okay, so what does this tell? And then we see falling oil, rising dollar CAD. Now, if I invert this scale, you see how close it is. Okay, so in other words, what this tells us is if there's, and notice how you see the chart goes, this green is inverted. So as this is oil price, if oil prices goes up, that's oil prices actually getting cheaper. Okay, so if oil keeps selling off, we'd expect dollar CAD to move higher. But if everyone's like, oh, Omicron variant is less deadly, vaccines work, yada, 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 good news, we expect oil prices to surge higher. So what do we expect to happen to dollar CAD? To tank lower. Okay. Now I'm just going to reinvert. I'm just going to, take off the oil chart, but that's a key relationship. So that means, going back to the main screen here, that means that if we see reassurance about the Omicron variant, that we expect dollar CAD to drop sharply lower. That's the opportunity, and expect stocks to potentially move higher as well. But the best currency pair opportunities is here. And if you haven't seen, if you haven't taken a screenshot of this, do. Now, on the other hand, if we see data suggesting Omicron is more lethal than Delta, then we're likely to see a more risk-off trading. And these are the currency pairs that are worth trading. Okay, so if the Fed are more hawkish, if the data says that Omicron is more lethal and the vaccines don't work, if there's a surprise beat in headline inflations, then inflation expectations, we expect dollar yen downside, euro pound upside. And let me just talk you through this. So the dollar yen upside is relatively straightforward, and I'll show you why. And this is what you're looking for. Go over back to this other screen. Right, now, if you look at dollar yen, you can see that dollar yen tracks the 10-year yields very sharply. If there's strong risk-off trading, we expect 10-year yields to drop lower and dollar yen to drop lower with it. Okay, so you can see how closely the dollar yen tracks the US 10-year yields. Rising 10-year yields, rising dollar yen, falling 10-year yields, falling dollar yen, rising 10-year yields, rising dollar yen. Now, correlations aren't always perfect, but they're pretty reliable, generally speaking. And generally speaking, the reason that the dollar yen tracks the US 10-year yields is because Japanese bonds have been so flat for so long. So if we just looked at the bond yield spread here between US 10-year yields and Japanese 10-year yields, what you'd see is that it's very similar to the, hang on, let me just, US 10-year. You see it's very similar. Here we go, right, to the 10-year. Let me just, there we go. Okay, that's it, right. Just got that up, and then let's get rid of that. There we go. Okay. Do you see how the bond yield spread between the US 10-year and the Japanese 10-year yield is virtually the same? That's because Japanese bonds aren't moving, because the 10-year Japanese bond yield spread is undergoing yield curve control by the Bank of Japan. So really, what you're really looking at here is the move in the 10-year yields. So very straightforwardly, dollar yen is tracking the US dollar 10-year yields. That's the thinking behind it. So you can just see how that works. So if the Bank of Japan start changing their policy, then this won't work the same way that it currently does now. But that's key. Now, the other key pair to look at is the euro pound pair. Now, if we see risk off trading, we'd expect to find upside in the euro pound. Now, I'll show you why. Now, the euro, again, is a funding currency. Now, the Bank of England would most likely postpone interest rate hikes if we have an Omicron variant that's going to be breaking out. So we'd expect to see the euro gain as it loses some more of its funding currency status. And we'd expect the pound to lose value because the Bank of England will be less likely to hike interest rates, and it has a slightly higher beta status. So if you look back to our currencies, do you see how the Aussie, New Zealand dollar, pound CAD, were weak after the COVID-19 variant broke, the Omicron variant? Do you see that? So that more high beta status means euro pound upside would likely continue. You can see that that's still the case. Okay, folks. Now, other things to be looking at during the week. We've looked at the main event, right? We've got the RBA meeting overnight. Now, what do you remember with the RBA? The last central bank meeting, they took a more hawkish stance. And so what they said is that, yes, we're going to stop yield curve control in the 3-year bonds. Yes, we are going to drop the language about no interest rate hikes till 2024, but Governor Lowe is very bearish. We're not expecting to be raising interest rates anytime soon, yada, yada, yada. So he did a good job of doing a hawkish policy action, but still talking down the Aussie dollar. So will the RBA keep that bearish outlook? Okay, very quickly, because we're running short of time, here is the outlook that we have for the coming week. So just take a quick screenshot of this so you can look at it in detail, but I want to make sure I get time to cover everything else as well. So just take a quick screenshot of that. But the bottom line is, if they have an early end to QE, if they show confidence around labor data and inflation data, if they're not phased about the Omicron variant, then we expect upside in the Australian dollar. But remember those twin issues the market's worried about: the Omicron variant and what actually happens, and Fed policy. So you have to bear that in mind, that this story is second fiddle to the main story that I've already mentioned. If they're sort of surprisingly dovish, then expect more Aussie weakness. So if they extend or increase the current 4 billion Australian dollars QE purchases, if they stress that inflation target is very long away, they're worried about employment, if they're worried about the Omicron variant, expect more Aussie weakness. And then the expression to trade that against would be the Aussie New Zealand dollar pair. So you would use the Aussie New Zealand dollar pair to express a bearish New Zealand, a bearish Australian RBA interest rate decision. And look at this, the bond yield spread between the New Zealand and the Aussie spread. You can use that as a proxy. Okay, so let's just, there we go, on that one there. Right, and you can see that if the RBA were really dovish or really hawkish, you'd expect to see that in the bond yield spread. Okay, so that's a quick proxy if you want to really see how the market's analyzing that when it comes to the event. Then we got the Bank of Canada interest rate decision on Wednesday. Once again, like oil prices moving lower might just make the Bank of Canada a little bit more more dovish. There have been some decent data out of Canada recently, and there was some decent data out last week. So if you just take a look here at the CAD, where was it? It was coming in on Friday. Excellent employment, 153,000 added. Unemployment rate down to 6%. Productivity, better than expected, and like 70-odd thousand was full-time jobs. So fantastic print for Canadian employment. So the expectations are that they, could well be more hawkish. So watch out for that. And if they are more hawkish, then dollar CAD downside. The environment to look for is positive Omicron news, then a hawkish Bank of Canada, and we could really expect some good upside in the CAD. And if you notice, if we just zoom out, since the last interest rate meeting from the Bank of Canada around sort of the end of October, beginning of November, a lot of CAD strength was priced in before the last more hawkish interest rate meeting. We've seen the CAD drop recently. So a hawkish Bank of Canada and positive news would be good for CAD upside. So something like if we suddenly saw a hawkish Bank of Canada and positive Omicron variant news, look for CAD yen upside. That would make sense. Governor Lowe speaking, so he'll be analysing how the market reacted to the decision. Then CPI data is going to be key on Friday. So what we want to look for here is if it's very low inflation data, then that will reassure the markets that the Fed doesn't have to move so quickly on interest rate hikes. So that will be a really key one to be watching out for. Okay, inflation is very important, and notice that the kind of expectations are that the US CPI projections will drop lower over the coming year. Okay, so yes, they're expected to be high, but then start falling. Now, if they start falling early, that's going to be excellent news in that no, the Fed won't need to move so quickly. And so we'd expect to see dollar downside and upside in silver and gold. So that's what I'd look at for CPI data. Okay, folks, just going to go over to the Q&A. I hope that's helped. I hope some of that has been insightful. I hope that helps helps frame the key dynamics that's going on in the market. So I hope you feel prepared, and I hope you feel like you understand what's going on now as a consequence. Omicron variant fears, Fed future rate hike fears, essentially. Okay, Josh, yeah, thanks. Got some questions here from you, Josh. Is that negative for Antipodeans? Too fast, too quick narrative? Yeah, good, Warren, that's excellent. I'm glad that's clear. Josh, just want to get your question right. Is that negative for Antipodeans too? Too fast, too quick narrative. Basically, if the narrative turns risk off, then you expect Aussie, CAD, New Zealand dollar weakness. So in other words, if those Omicron variant fears grow, then expect the Aussie, CAD, New Zealand dollar to weaken. Does that answer your question, Josh? If you're uncertain, pop your question in here now. I hate people being uncertain. I want everyone to, have their question answered. So do make sure. Thanks, Warren, for the feedback. That is good. Yeah, nice one, Josh. Well done. Yeah, it's all clear for you. If anyone else has got a question, please do, speak now or hold your peace. We'll be back on Wednesday, and I'll get us totally ready for that Bank of Canada decision. So I'll look at the sentiment heading right up to the Bank of Canada meeting. Give us a few currency pairs to look to trade. Okay. So make sure you come back on Wednesday. Otherwise, folks, that's great. That's the end of the questions. Really have a really good rest of the day. Really enjoyed this session because I'm just pleased to help folks understand what's going on. Take care, everyone. Have a really good rest of your session. Goodbye.